Many people invest in stocks, but few really know what they're buying or if they're getting a good deal. That's why in today's video I will show you how to easily evaluate whether a stock is cheap or expensive and how to truly understand its upside or downside. We will use Netflix as our example and evaluate the stock based on its revenue. This is a very important video for everyone who wants to invest, so what I recommend is that you stay around until the end. So the first thing we need to understand is that companies are traded based on multiples. You've probably heard already people saying that a certain company trades at X times its revenue, right? Great companies that everybody wants to own are usually traded at higher multiples. For example, Palantir is currently trading at 40 times revenue, which is a very high multiple. On the other hand, companies with a lot of debt or with very low margins are usually traded at lower multiples because their revenues and profits just don't have a lot of quality, as there's little to nothing left for the final shareholder. Ford, for example, trades at less than 1 times revenue. Actually, Ford is trading for around 0.3 times its revenue, which is a very low multiple. And this happens because Ford has a lot of debt and pretty low margins. Anyway, the important thing to understand here is that companies are traded based on multiples, okay? And this will make more sense as we go along. Now, before we go to our Excel sheet, if you enjoy this kind of content, make sure to hit the like button, and I also invite you to subscribe because it takes a lot of work to make these videos, really. So now we are here in Excel, and don't worry, this will be simple, though a little bit laborious, okay? So let's start creating our valuation sheet. So let's create 4 columns. The first will be called N, the next one will be year, the next revenue, and the next growth. Let's centralize everything. Let's place our years here now. Let's start with 2018, going up to 2030. 2030. Let me just zoom in here. Okay, so let's make a 7-year projection here. Let me just do this. And let's color the projection area in a darker gray. Okay, and let's write here Netflix because it's the company we will use as our example. What's Netflix current price? $701.35. Okay. Okay, so next step, let's get all the information we need to fill the revenue column, okay? I will use Seeking Alpha, but you can use any source. Done. So now we need to know how much Netflix revenue has grown from 1 year to the other on average. For that, we will come here and apply the following formula. Equal, open parenthesis, newer number minus older number, close parenthesis, divided by older number. Now let's just drag this down. So next step, let's build our projection tab here. Let's start with Netflix average growth rate, which is 16%. You cannot see it, but here it is. Here, 16%. Let's write this down, 16%. Now let's create our projected growth cell here. And now our average multiple sell. Remember I told you companies are traded through multiples. Now let's create our projected multiple sell too. We are almost there. And now we have to find how many shares outstanding Netflix has, which according to Seeking Alpha is around, Netflix has around 430 million shares outstanding. So let's write this here, 430. Oh, and by the way, I will leave a link in the description below to Seeking Alpha with a 1-week free trial and a 10% discount. Have fun. Next step, let's write here, future fair price. And for now, that's it, but we will continue to build this later. Now, let me just put some color here, okay. Okay, let's centralize everything, as always. Great. Now let's start to play a little with some numbers, right? So as we've seen, Netflix has been growing at an average rate of 16%, okay? So let's project here. I always prefer to project lower numbers, more conservative premises. So let's say here in our projection that Netflix is going to grow around 7% on average for the next 7 years, okay, until 2030, just as they did in the last 2 years, okay? But as we've seen, nothing has happened, right? We've just wrote 7% here and nothing has happened. That's because we still need to set up some things. So let's come here to the growth section and let's type equal to this cell. But here we have to put the $sign here so we can lock this cell here. This way, if we drag this cell down, all the others will mirror the same cell, will mirror this one. Now let's go to our first year in our projection. And by the way, we have to enumerate the years in our projection here, which I forgot to do. Now let's come here to the revenue section, to the first year in our projection, and let's type equal to last year's revenue times open parenthesis 1 plus the growth rate for this year. Close parenthesis, enter. Let me just do this. Great. And now we only have to drag this down. And that's it. Our projection tab is almost complete. So now if we type here, for example, 10%, everything changes. So everything is working. But let's come back to 7%. Okay, so now we are here in the multiple part. So now we need to find the historical average for Netflix price to sales multiple. And we can find this information in this website, Macro Trends. It's a free website and I will leave its link in the description below, okay? But as we can see here, Netflix is currently trading at 8.65 times its revenue, but its historical average stands at around 5 to 6 times, okay? So let's write here 6 as our average multiple. And let's project here that in 7 years, Netflix will be trading at around its historical average. So let's say at 7 times its revenue, okay? Let's be a little bit optimistic here. But to get to our future fair price, we still need to set up some additional things. To find our future fair price, we need to type here equal, open parenthesis, our last year revenue here, times our projected multiple, close parenthesis, divided by the number of shares outstanding. Enter. So according to these premises, the fair price for Netflix stock in 7 years should be $881. Okay, great, but the question now is, what should I do with this information? Because until now, I only know that according to these premises, the fair price for Netflix stock in 7 years should be higher than what it is today. But so what? Because it's not because a stock may go higher that it makes a good investment. So now, to better understand the viability of this investment idea, we need to know our total return and also the projected average rate of return per year. And to get this information, we need to come here and type total return, and we need to type here equal, open parenthesis, newer number minus older number, close parenthesis, divided by older number. Enter. So according to these premises, in 7 years, Netflix would generate a total return of only 26%. Now, to better assess, to better understand this rate of return, we need to find out how much it represents per year. So let's write here equivalent return. And now let's come here and type equal, open parenthesis, our total return plus 1, close parenthesis, raised to, open parenthesis again, 1, because we want to know our yearly return, the return of only 1 year, over our total number of years. Close parenthesis again, minus 1. Enter. So now we can see that if Netflix ends up delivering a 7% growth rate on average, and if this stock ends up being traded at 7 times revenue in the future, well, in this case, we would have a 26% total return, which would be equivalent to 3.3%. So in this case, would Netflix stock be considered a good investment? Certainly not. Because if you invest in a 5-year treasury bond, you could actually get an even higher rate of return of 3.9%, as we can see here. So if you're counting on these premises, if you're counting on a 7% average growth rate and on a 7 times price to sales multiple in the future, well, if you're counting on this, it just doesn't make much sense to take on risk by buying this stock. It doesn't make sense to take on risk for a theoretically lower return than a treasury bond. For this stock to make sense right now, you would need to have much more aggressive expectations. So you would need to be counting on, let's say, a 12% growth rate. Now it would make more sense because this way your equivalent rate of return would be 8.15%. Now this makes much more sense. But even so, I still think this is a low rate of return to take on the risk of investing in stocks. In any case, here you have to ask yourself, how likely is it for Netflix to deliver this kind of growth? Do you think it's unlikely that Netflix will grow at 12% per year? Because if you find that improbable, then, once again, it doesn't make much sense to go long. Now, at what price would I start thinking about buying Netflix? As I've said, I like to have a lot of margin of safety. That's why I prefer to look for companies that are trading at very low expectations, at very low premises. So let's say Netflix doesn't grow at all until 2030, okay? So let's say they grow at 0% per year. And let's say that in the future, they will be trading for 5 times revenue. So in this case, Netflix future fair price would be $392. So this would be our future fair price according to these premises, according to these expectations. So the question now is, at what price would I need to buy them now to get around a 10% return based on these very pessimistic assumptions? So let's say I managed to buy Netflix at, let's say, $300. This would mean that my equivalent return, based again on these very pessimistic assumptions, but my equivalent return would be 3.9%, which would be still low. But what if I manage to buy them at, let's say, $200? Now, at $200, if I have the chance to buy Netflix at this price, let's say the stock dropped a lot due to recession fears or something. But at this price, this stock would certainly interest me, because at that price, I would be buying a stock priced based on assumptions that probably wouldn't come true. And even if the worst case scenario played out, I would still be looking at a 10% return. Oh, but Netflix will never come back to these price levels again. Well, so I will be focused on other investment theses. Anyway, that's how I use this valuation sheet, this valuation method, and that's how it helps me to better think about the investments I'm looking at, because it helps me to assess what's being priced in. So this method was based on revenue. It's a simpler method. For example, it doesn't take into account debt, but in any case, I'm planning to do a valuation playlist. In the next video, for example, I want to continue to develop this Excel valuation sheet. I want to show you how to do the same thing, but using profits instead. It's just a little bit more complicated. I also want to do a video about the discounted cash flow method, but I will work on that over time. Anyway, I will leave this Excel sheet in this video's description so you can play with the numbers yourself. After all, valuation is actually a very personal thing. For example, if you have some reason to believe that Netflix is going to grow 30% per year for the next 7 years, then we have a bargain here, right? Anyway, that's it for today. I hope you've enjoyed this video, and see you next time.